Welcome back, real estate investors. My name is Chris Knight. I'm the business development manager here with Red Door Property Management. And as you all know, I'm joined with Mike Taylor, broker, owner of Red Door Property Management. Mike, how are you?
Excellent, Chris. How you doing?
I'm doing really good. And today we have an amazing episode planned for everybody today. We are joined with special guest Tevis Durbin, who is a specialist with mortgage lending, specifically as it pertains to real estate investors. So I think you're going to get a tremendous amount out of today's episode. Let's find out a little bit more about Tevis. Tevis, give us a little bit of background and what it is that you actually do.
Yeah, thanks for having me. I appreciate it.
Absolutely.
Been in the business for about 25 years. Been with this company for 11 years, and my wife and I work together. Been doing it for 18 years, and still going strong on both sides of the business and personal. But we really have honed in on the real estate investor side of the business over the last couple of years. We feel like that's a good niche for us, and the company's out of Texas. Been in business for 25 years. It's a private company. And it's a good family-run company, good small but yet still big to get it done. We're in every state.
Yeah, that's great. That's great. And I'm sorry, did you mention the name of the company that you work for?
Supreme Lending.
That's Supreme Lending.
Yes.
Okay, but you're based out of
Fishers. I've got two locations here. I've got one in Fishers and then one in Elkhart.
Okay. And what it is that we're trying to achieve today, we're going to try to give really the full overview of the life cycle of trying to secure the loan, what documents you might need beforehand, before you even get into the consideration of meeting with someone like Tevin, and then of course the ins and outs of all the intricacies, all the different lending vehicles you might be able to secure throughout the process, just to give you a little bit of insight before you even get the ball rolling. And then of course, if maybe you already have multiple investment properties and you're looking for other lending opportunities to expand your portfolio, we hope to get into a lot of that. So, and why don't we just go ahead and jump right in? I've got a list of questions here, and I'm certain that we're going to go off topic every now and again. And I know Mike has a lot of insight, being a very active real estate investor himself. He's going to want to dig into a lot of the intricacies as we get into each one of these questions. So let's jump in. Can you give me kind of an overview of the current mortgage lending landscape for real estate investors? How much or how little can a real estate investor put down? What type of early lending options should a new investor be looking at? Let's kind of start there. And then I'd also like to get a brief overview of what you are seeing currently in the lending market. Are you seeing more investors coming in more than your individual single-family home buyer? Just kind of touch on each one of those topics if you can.
Yeah, so the market's really changed. I think COVID started everything with allowing people to work remotely. And so with the Midwest having a lower cost of living, we were able to see a lot of people kind of migrate towards Indiana. And so not only from a primary standpoint, but I think investors tried to get ahead of that and try to buy some properties out here with our lower property taxes.
Yeah.
And so I think it kind of started then. But then now you jump forward 3 or 4 years, and you've got affordability issues that are really starting to take hold. So a lot of people are choosing to rent instead of buy. I think I saw a statistic the other day where they said the average age of the first-time homebuyers gone up from 30 to 38.
Wow.
And so I think there is a huge demand for rental properties or rental needs. Yep. And so I think that's really helped the landscape from that side for real estate investors. So I think that's the first thing. We're seeing more of that. We had a meeting with the owner of the company at the end of last year to kind of talk about what we wanted to do this year. And he said he felt like our business would be anywhere from 10 to 20% just on the real estate investor side.
Wow.
He thinks that's a huge push. So we've started to position our products around that. And I would tell you, if you jump back to 2020, most lenders only had one option for investors. It was just a Fannie or Freddie product, and where you're putting 20% down back at that time. Yep. And things have evolved since then with the additional products, and people are getting creative with less money down or other options for them.
Yeah, maybe we could talk about that a little bit because, I've been in real estate for 20 plus years, and you've been doing this for a long time too. So, I was in it back before the financial crisis, and there was, anybody could get a loan that could fog a mirror. They had the no income, no asset loans. I call it the liar's loans. And then we had the financial meltdown, right? And then you couldn't get a loan for anything. And so where are we with that? Are lending guidelines, have they loosened quite a bit? Are we kind of in the middle there? Like, where are we in terms of, how loose is the lending environment right now?
Yeah, so we're definitely starting to take some of the guardrails off for sure. But the big focus after 2008 was ability to repay. That's all we heard was, can they afford it? Can they repay it? Because like you said, the liar's loan caused a lot of default, and people came back and said, well, you should have known. So the focus was on ability to repay more than anything. Now you're starting to see, because everybody's got so much equity in their properties right now. Yeah. Nobody's going into default. Right. Nobody's doing a short sale. And so these loans are performing. And so you're starting to see an appetite to take on more risk. And so we're not back to the liar's loans, so to speak, but you are starting to see a lot of non-QM, non-agency loans start to play back into a factor. And so they're just getting... They're starting to open up options, but what they're doing is they're still hedging their risk. So they are charging maybe a little bit higher interest rate than they will once they get some data to see how these are performing.
Mm-hmm. Okay. Have you seen any key differences between the underwriting process for an owner-occupied property versus an investor type loan?
Yeah, so they still, with owner-occupied, they believe that even if we were to go into a recession, or whether we're there now or not, they feel like people would always maintain where they live. So therefore, you start to have that implied risk if you go into a second home or a rental.
Of course.
And so, yeah, underwriting is tougher on that. I would tell you, for a first-time home buyer that's going to live in a house, I mean, you've got programs where you can go as low as 580. But when you're talking an investment property, if you're under 700, they really penalize you on rate, and also they want more money down. So they still have a much higher standard for that investor market right now, just because of the perceived risk if things were to go south.
Oh, that's gold, yeah.
Just to clarify, you're talking about credit score, correct?
Yes, I'm sorry, credit score, yeah.
Yeah. So credit score is of paramount importance if you're an investor.
Yeah, it really is. Not that you can't get something done, but there's a huge hit to rate, closing costs, money down if you're south of 700.
Yeah.
So are there specific factors that you would consider critical when assessing the risk aside from credit score of financing and investment policy?
Obviously, if they do have a current housing expense that they can document, that's huge.
Okay.
So it could be rent, like if they're renting an apartment, that's okay. But if they have a primary house, a mortgage or something like that, that's huge. The other thing is cash, assets. I mean, that's just a huge, not only do they have money down, but they also have what's called a reserve account. Those are very critical pieces of the puzzle.
What types of different financing options there are for, and we work with different types of investors. We work with small investors who may be high wage earners, get a W-2 job and want to add 1 or 2 or 3 or 4 rental homes to their portfolio. And then we do also have kind of more serious investors who have a small portfolio or a small maybe apartment complex.
Yeah.
So maybe just go through kind of what options for different people and what you might recommend for different.
And before you get started there, just to give you a little bit more of an expanded idea of our typical investor is, an overwhelming majority of them are W-2 employees. And a lot of them, in fact, are one of our most recent podcasts that we did was with one of our portfolio builders. And he started by pulling out of his 401k. So even if you can speak to that, is that a good idea? Is that necessary in some cases to generate the cash down in order to get into some of these loan options?
I guess I would start, like I said, if you jump back 5, 6, 7 years, the standard option really was through Fannie and Freddie, whether you were W-2'd or self-employed, you're putting 20% down, good credit score, you've got to have assets. And what we've tried to do is evolve from that and open that up more. It also used to be that you had you couldn't be someone that's never owned a house. So like if I were living in an apartment and wanted to buy a rental property, that was tough 6, 7 years ago. Yep. And so they've started to relax that a little bit, and companies are trying to create other products. So we can go as little as 15% down. A lot of people think you have to do 20 because of a mortgage insurance. There's 8 different mortgage insurance companies, but only 1 or 2 will offer mortgage insurance on a rental property. And if you put less than 20% down, you have that. So we can do as little as 15% down, which helps. Chris, in regards to the question of pulling out of a 401k, that's going to vary for every investor. I mean, obviously in the timing of the market, if we're at a high in the market and they want to pull out, they can. Some clauses will allow you to pull out to buy a house and not penalize you. There's a clause that maybe that needs to be a primary residence versus a rental. So there's a lot of variables on that. but you can't borrow that money. So that the money down on an investment property can't be borrowed. The other big distinction is
Understood.
when I'm buying my house that I want to live in, and say I'm a first-time home buyer and my grandpa wants to give me the down payment, gift it to me. You can do that on a primary, not on a rental. So they really want that to be your own money. They want to know that you've been able to save that money and are willing to invest that. And so that's kind of a key distinction. But as far as some other products, as you start to build your real estate portfolio, sometimes you want to build that quicker than the guidelines will catch up with you. So reporting that income on your tax returns. And so that's where you're starting to get into some hybrid products like a DSCR loan or a debt service coverage ratio. And so that allows people to continue to build that portfolio maybe quicker than guidelines would prefer it. The other thing is your traditional agency products, they would limit you on the number of properties that you had. So you could have up to 10 financed properties. Well, as this segment of the business grows, there's people that are going to have more than that. Yep. And so you've got the opportunity to loosen those restrictions. And then I guess finally, as we kind of hit this from a 30,000-foot view, people are getting creative and they want to know, what about if I can close this in an LLC? And traditionally, that was something you couldn't do. And now you're starting to see people open up to where you've got options of closing these, investing these within a limited liability corporation versus straight individual.
Okay, yeah. I mean, you're buzzing right through a lot of these questions, so you're stealing a lot of my thunder. But it's really this is awesome information. Go ahead, Mike.
Let me just back up, because I think, like I said, our audience is a pretty wide range. We've got some pretty experienced investors, but I think some people really just starting to get their feet wet too. So let me just back up, because I know that we've all been doing this for a long time and kind of throwing around some jargon. So let me just back up and maybe just explain a couple things. So, when we're talking about Freddie and Fannie, so and correct me if I'm wrong, but that is going to be your traditional loan that we've kind of always thought of, right? More of like a owner-occupied home, but they do offer that for investors. And so that why when we say Freddie Fannie, that means you're going to get a traditional loan from like you guys, but eventually that's going to be sold off, and Freddie and Fannie are going to back that loan. And so that's what just kind of more of the traditional loans.
Correct. Like when people hear conventional or standard, that's your bread and butter, versus like FHA, government loan. So yeah, that'd be Fannie and Freddie or the agencies.
Sure. And your down payments, I assume, they're different between both products, right? So FHA, do you still require the 20% down?
No, FHA is not for an investment property. It's strictly primary, and that's 3.5% down.
Okay. Okay.
Yes.
And then you start to get some more kind of advanced, like you said, the DSCR, the debt service coverage ratio, and that is basically where you don't necessarily look at you as an individual. You're more looking at the asset and how the asset can pay off the loan and service the debt on the loan, hence the name, right? The debt service coverage ratio. And there's a little bit of an equation on that to determine, can this asset substantiate the debt service on this loan?
Right. We can expand on that. Do you want me to now, or?
Yeah, go ahead. Let's just jump into it. Yeah.
So what's nice about that is, let's just say, if I'm W-2'd or self-employed, because there's different variables, but if I'm self-employed and maybe I'm writing off with expenses my income, so I'm showing a lower adjustable gross, and maybe that's okay for my current environment, but as I buy some of these additional properties, it puts some pressure on that.
Yeah.
When I say on that, your debt to income ratio.
Right.
So there's some higher standards as you buy investment properties. So what we offer with this debt service coverage ratio loan is we don't require any income documentation. So we don't need to see tax returns. We don't need to see pay stubs. What we're looking at is strictly when you get an appraisal, we ask the appraiser to tell us what the market rent would be for that house, comparable homes. And then based off of that, what we're looking at is, will the market rent be greater than your payment on that? That's kind of that ratio that we're looking at. And if so, you can buy it. So that's kind of so I've got people that are self-employed and they would prefer not to show their taxes. Maybe they are writing things off. Maybe they just formed an LLC. Maybe they're switching the way they structure it. Or I've got W-2 individuals where it's just, maybe I only qualify for a $150,000 investment property, but I'd like to buy a $250,000 property. Yeah. So it allows that flexibility.
And is there any delay on when those payments are started on a DSCR? Do you only start making payments on that loan once you place the tenants?
No, unfortunately, it would. So you would still start making payments usually within 30 45 days after closing,
Gotcha.
regardless if there's a tenant or not.
Okay.
So on these DSCR loans, is there a loan limit on them? I mean, let's say I find a $1 million apartment complex.
So that could vary from lender to lender.
Okay.
Most of them are going to follow, they could follow agency guidelines. So you're going to be somewhere in that 760 range.
Okay.
There are some exceptions where you can go up to $1 million.
Okay.
I'm not sure off the top of my head if anybody is offering greater than $1 million at this time.
That's kind of
that'd
the
be
cap.
yeah, I think so.
Okay. And then what about the actual the math behind the coverage ratio? What are you guys looking at? Are you guys just looking at, hey, here's the rent minus the taxes? Like, what is the actual math behind you determining that ratio? And what is the ratio? Does it depend on the lender? Is it like, I've always heard like 1.0, 1.25?
Yeah, so it's even on an investment property, you do have the option of escrowing your taxes or insurance. So because if you put 20% down, you could decide to pay your own taxes and insurance or escrow. Whether you do that or not, we're looking at the full housing expense, so the principal, the interest, the taxes, the insurance. So that's what we're looking at as far as the payment. And then on the market rent, the appraiser will usually give you a range. So based on comparable homes at this price, market rent could be $1,500 to $2,000. And then they'll say, but we feel like it's $1,900. So that's going to be the amount we use. 1-to-1 ratio is the sweet spot. Okay. So if you are greater than 1.25, so if you've got a higher market rent than your payment, you get a better rate. Okay. You get better financing terms. Okay. If you're south of that 1-to-1 ratio, you can still do it, but it's definitely going to be a higher rate, higher cost, things like that. But then also they might require a minimum loan amount greater. So like a lot of DSCR loans will start off with a minimum loan amount of $100,000. But if that ratio is less than 1, they want it to be $250,000. Gotcha. Usually the floor though is 0.75. So anything less than that, very few lenders will offer.
Okay. Is it just strictly that straight math? Like you said, the 1900, we'll use that for example. Do they calculate anything for say vacancy or maintenance, or is it just, hey, here's the market rent, here's the payment, and that's your ratio?
Nope, that's it.
Oh, it's pretty simple math.
Very simple.
What kind of down payment options on these DSCR? Let's just stay with these DSCRs for a minute.
Yeah,
because
let's
we'll just do a little bit of a deep dive. What kind of down payments are you looking at on these DSCR type loans?
Usually 20%. Okay. Once again, and what I try to share with everybody is there are different sweet spots. So you could get much better terms if you did 25% down or 30% down, but the minimum's usually going to be 20% down.
Okay. When you say better terms,
better rate, better closing costs, things like that. Now, the other thing that's very unique to these DSCR loans are prepayment penalties. So that's the other thing, because in Indiana, very few loans will allow you to charge a prepayment penalty. But on these DSCR loans, you can. And it's anywhere from 1 year to 5. And it's like if I have a 5-year prepayment penalty and I refinance or sell in that first year, it's 5%. And then it drops down 4, 3, 2, 1. You get so much better favorable financing if you do a prepayment penalty. And I'll share that, but typically 3 years. If you do less than that, it's a pretty hefty hit to the fee and the rates. If you do 5, it's not as much of an advantage. But that's where you just really have to educate your investor. Are you thinking about refinancing this within that 3-year period? What's going to be the cost? What's your cash flow on it at that time? Are you looking to flip it and things like that? But it's typically there's different options on that, and we just kind of walk them through the numbers.
Well, okay, so that's interesting. So, I mean, a lot of our investors are working the Burr method, so they are expecting to refinance the property shortly after placing a tenant. So, are you saying that using one of these DSCR loans is probably not something that they're going to be looking for with that prepayment penalty?
You could still choose not to do one.
Okay.
It's not a requirement. Okay. It just gives you better financing.
Gotcha.
And so typically what I might do is if that's the case, then we wouldn't do one. But then when we refinance, we might to try to lock in a better rate and better terms since they might be set now that they've got a tenant.
Okay. All right. Understood.
Is there a premium that an investor would pay for getting a DSCR loan versus a conventional? So like, are you going to pay a higher rate for the convenience of, because it sounds really convenient. I mean, it's a lot easier. I've done a DSCR loan and I've done a conventional. I'm self-employed, so it makes the conventional a lot more difficult. I did a refi on a rental house I did it was maybe 5 years ago, and it was, oh my gosh, it was brutal. I said I'm never doing that again, and I haven't. So I've trended more towards the DSCR personally, out of convenience. Being a self-employed person, it's more convenient for me. It was like a part-time job providing all the information. So anyway, back to my original question was: is there a premium that that an investor will pay for a DSCR versus a conventional loan?
Yeah, absolutely. And it's not so much that it's a DSCR loan by title. It's you're paying a premium because you're showing the underwriter less cards.
Right.
I'm not showing you my taxes. I'm not showing you any income. So therefore, that's a perceived risk. And so there is a premium. What I typically tell people is it just depends on where you're at in the process. If you can put 20% down and your income, you can verify it and document it, you can typically get a better option going the traditional route.
Right.
It's what if you can't? And then so I never present just a DSCR unless I've got an investor that's all they've done and they know that's what they're looking for. If I've got a first-time investor, I've got a tool where it'll show these things side by side, 4 different options, and it's at a 30,000-foot view so they can see payment, rate, out of pocket, and then they can always drill that down, but then they can see the differences. The other thing I think we skipped over is on a traditional loan for an investment property, the agencies, Fannie and Freddie, they've imposed what's called loan level price adjusters, which I know we're getting a little bit deep, but what that basically means is they're telling us as lenders, they're charging us, say, roughly 3 points that we have to pass on to the consumer. So the closing costs are automatically higher on that versus DSCR, because it's a specialty product, you don't have to do that. Okay. So that's why there's less fees. So there might be a premium on rates. So once again, it's just kind of showing them side by side the different options, and they can decide from their standpoint. But as far as ease, it's definitely easier to get a DSCR loan closed because we're just not asking for all that additional documentation.
This side-by-side thing that you're referring to, is that something that changes as the loan products themselves change? And the reason I ask is I'd love to get my hands on something like that and maybe even have it display during the podcast or something like that.
Yeah, so what's nice, I do this for first-time home buyers, but I also do it investors because it's a link, and so I can update it, and it can be live.
Okay.
But what it'll show is those different options. But then if they call me and they say, "Hey, Tevis, I'm looking at this property on Delaware," I'll pull it up. I can pull up the property taxes, what that costs, and I can update all those options live so they can see how it changes.
Okay, so I'll talk with Devin here a little bit, and I'll see if we can't get a link, and maybe we can pop that down in the description when we post this video. But so I want to get into a little bit of the nasty. I mean, we've talked about the interest rates, and I mean that's what a lot of people are talking about right now, especially investors, as they're struggling at their ability to cash flow with current interest rates. So I mean, I don't want to harp on it too much, but I do want to get into how are interest rates determined for investment properties versus mortgages that are for owner occupied.
So and once again, it can vary, but if we want to just generalize it, you basically, and obviously the more special of the product, the higher that premium will be. But let's just say typically you're going to be about 3/4 of a rate higher from a owner occupied to an investment property, ballpark. And then it could be higher on the DSCR loans. The other thing is, and I don't think we mentioned it, but on a DSCR loan, and I think we've got another product, you can do an interest-only option. So that's where, as an investor, I try to share with them, interest rate is important, and I don't try to act like it's not. However, I'm really looking at cash flow.
Right.
So what if you're already putting 20% down. What if we looked at an interest-only option to lower your payment so you've got a bigger cash flow spread? And then we can go from there as an option.
Okay.
Are you seeing one, are you seeing, and then two, maybe you could talk about options that are available for both conventional and DSCR, but you mentioned interest only, but are ARMs available? So an adjustable rate mortgage, are you seeing those? Are you recommending those? And are they available on both products?
So at least with us, on a traditional investment property loan, we don't offer an ARM.
Okay.
On our DSCR loan, we do. Okay. And we've got another, it's called our Investment Flex product, we do. Right now, because the yield curve is still a little bit inverted, So you've got short-term rates are almost identical as long-term rates. As that flattens and gets back to a more normalized market, you'll see ARMs be very popular. And typically, you won't. It's usually a 7-year ARM, so it's fixed for 7 years and then it turns variable. There's also a 10-year ARM option, but right now we're not doing any of those. Even though we offer them, it's just not. There's no advantage to it right now.
Got it. It's kind of like the 1 month T-bill is the same month as a 10-year T-bill. So why would you buy a 10-year T-bill, right?
Right. Exactly.
Okay, that makes sense. You mentioned that when you present this to an investor or a home buyer, you kind of give them 4 options. I think we've been talking about 2. Are there other 2 options that we want or you want to discuss?
Sure. So when we first started developing our products for investors, what we looked at is the traditional product, the closing costs were just outrageous. And that's because they were being pushed through from Fannie and Freddie to lenders. So we created a product where we could almost do away with those. But we require 25% down instead of 20, but we almost are saving them that 3% hit. So they're putting more money down, but the out-of-pocket's almost the same because they're not paying that additional closing cost.
So that 3%, I know you just talked about it, but that is just on all investment properties coming from Fannie and Freddie. That's just getting pushed to the home buyer.
I would say I can speak on behalf of us and a lot of mortgage banks. You might have some retail channels that can absorb that, maybe a credit union or a bank, but they are definitely pushing that down. It's whether or not they can absorb it.
Got it.
So to be fair.
Okay.
So our first product we created is how can we, because when I talk to a lot of investors, they tell me, Tevis, man, you're beating me up. I got to put 20% down and your closing costs are just outrageous. I can't do it. I don't have any money for rehab, or I don't have any money for the next property I buy. And so we went to the owner of the company and said, okay, what if they put 5% down more? Granted, that's still out of pocket, but we can cut the cost. And so that's the first thing we created. The next thing we created was the Flex product. And that's where it can get a little technical, but like, for instance, what if you had a DSCR loan where it was just in an area where the market rent couldn't support the payment? Well, a lot of times that meant you couldn't buy it then. Well, our Flex product still gives them that option. So we can do a coverage ratio less than 1, less than 75 on that Flex product. Sure. So we're just trying to it's kind of like you see the dam cracking, you put your finger in one hole and another one pops up. So we try to create another product. But so that's the 4 products are the standard. We've got one that if you put 25% down, you show all your documentation. It's a better rate, lower fees. We've got the Flex product that's kind of a hybrid between that and then the DSCR.
Okay. So I was going to ask you, so if I'm a W-2 employee, what product would you recommend to me? But I'm going to guess you're going to say it depends on the property and the cash flow situation.
Right. Well, and also what's your outlook? Are you going to buy one and you're done?
Right.
What's your appetite? Are you looking to buy several?
Right.
And what's your cash flow? Are we buying one that needs to be rehabbed or not? So once again, all of that will go into it.
Yeah, and we did touch on it, but I wanted to circle back on it because I don't think we explained it. But you mentioned, so if I'm thinking if I'm a W-2 employee and I'm a high wage earner, I have my own house, and I want to add like maybe 2, 3, 4 rental homes relatively in a quick fashion. We get those calls all the time, right? Hey, I'm adding to my portfolio, want to have 5 in the next 2 years. You mentioned it, but on a traditional conventional loan for an investor, there are debt to income ratio requirements where even if you are cash flowing, even if it's positive cash flow, if you haven't done it for a year and that cash flow isn't reported on your tax return, the conventional lenders won't count that as income to offset your debt payments. Is that correct?
Yes.
Okay. So that's when you may look at one of these other products.
Yeah.
Even though you could qualify, but the payments are going to start to add up on you quickly.
Right. Exactly.
Okay.
All right, if we're ready, I want to get into the loan to value and the appraisal process. Okay. So how does the appraisal process differ for an investment property for your average owner-occupied property? Is it different?
Yeah, so it can be, and especially if we're talking multi-units, duplexes, or even 3 or 4 units. But we're always going to want to see that rent component. What's the market rent support, especially if we're trying to do a DSCR or something like that. The cost can be about $100 more than your standard appraisal.
Okay.
Which will vary from lenders. So you might be somewhere between that $500 and $600 range on a standard appraisal. For an investment property, just add $100 to that in general. And then other than that, I mean, the appraiser's still going to value that property the same way they would any other. They're just going to look at that rent schedule as well.
Okay. All right. And I know, Mike, I know you had a big question here that we added regarding the down payment required following the loan amounts or the appraisal amount. So, for example, securing a great deal on a home under the appraised value, can I put less than 20% down? Do you want to expand into that a little bit?
Yeah, no, I know the answer to this, but I think we get this question a lot.
Just because we know it doesn't mean that they do.
Yeah, and I think it's worth talking about. Like,
Yeah.
So let's just say, let's just use easy math for example, but let's just say I just get a killer deal on a house, right? Let's say it's valued at say 150. Let's say I pick it up for whatever reason at $100,000. Is that going? What would my down payment be? Is there any way that I could lessen that out of pocket because I was able to secure such a great deal?
Unfortunately, we have to go the lower of the two. So yeah, so it would be on that $100,000. So if you're putting 20% down, it would be based off of that.
Okay, so it'd be 20% of the 100.
Yeah.
Okay. Okay. I mean, I knew that, and unfortunately,
Yeah, it's. But now what you're looking at is, and that's the other thing where on some of these products, if you want to refinance and either you've got two choices when you refinance, do you want to pull cash out, get some of your money back, or are you just looking to drop the rate and term? Most products, if you want to pull cash out, you've got to wait 12 months to go off that appraised value. There are a couple, like I said, DSCR and some others where you can at 6 months pull some of that cash out to try to get some of your investment back off that appraised value.
I think maybe that's a great transition into talking about rehabs and the Burr method and refinancing. Krista, I don't know if you have a couple of questions, but
No, really. Just I was going to let Tevis kind of lead the way there. So let's say I'm a new investor. I have one rental property now. I'm looking to refinance it to get into expanding my portfolio as quickly as possible. So I mean, what does that look like before I'm coming to visit you?
So as far as they're wanting to refinance and pull some money out of that first one to put down on the other?
maybe let's talk about two different scenarios. So one is I have a house and I want to pull some equity out. And then let's talk about maybe like a rehab. I'm going to go buy a house that I know is going to be a rehab because I think that would be maybe two different products, I'm guessing.
For sure. So the first one, like I said, on your traditional loans, if you want to pull money out of a property that you've acquired, you have to wait 12 months to use the appraised value.
Okay.
On a DSCR loan, you could do that at 6 months. Now, that can vary from lender to lender. So that's a way. So like in your previous example, if it appraised for 150, I bought it at 100. So maybe at that 6 month mark, I can go off an appraisal and try to get some of that cash back out. But you're still limited to about 80 to 75% of the loan to value. So there's really not a lot you can pull out in a short period of time unless you rehab it, fix it up, and the value is going to be even higher.
Got it.
The other question was on a rehab. So a lot of people have probably heard the term a 203K. And it's a renovation loan, and that specifically pertains to FHA.
Yeah.
And it's if I'm a first-time home, not a first-time home buyer, but if I want to buy a house I want to live in and I want to fix it up, that's what a 203K is. Well, a lot of people ask, what if I don't want to live in it? Is there a product available for investors? And that's called a home-style renovation loan. And what that will allow an investor to do is, let's say I want to pick up a property for 150 and I want to put 50 in it. So what we'll do is we'll get an appraisal subject to those renovations, and then we'll loan 85% off of that after improved value. So we'll finance in the cost to buy it and the repairs, and they can even finance in 6 months of the payments, because we know if you're rehabbing a house, you can't put a tenant in it.
Yeah.
So we're going to let them, if they choose, they could roll anywhere from 1 to 6 months in that. So they're really just coming out with their cash flow for the money down. The rehab can be put in it, and also the payments.
Wow,
So
that's really cool.
it is. Now, and I tell a lot of investors, and that's a product where there's no prepayment penalty on it, because we know you're borrowing more day one than the house is worth.
Right.
And it's an investment property, so the rate and fees can be higher. So what we'll typically do is that's a loan they only hold for about 6 months, and then we refinance it to get that lower rate. And then maybe at that time we do an interest only, we do whatever. But it's a good alternative. The one thing I'll throw out there, because I get this question a lot, can I do the work myself? And that's where just too many things going on at one time. So
You don't have to tell me, I know.
yeah, so we're like, no, we can't do that. We're going to have to get a contractor to do that and then go through it. So
What is that? That sounds like an amazing product. Is that something that you guys keep in-house, or is that
We'll keep it in house while the work's being done because there's draws that are going out and stuff like that, so that can get a little hairy. But then after that, it's a loan that we could retain it or we could have somebody else service it.
Okay. What does that look like underwriting wise, like paperwork wise? Is that a bear, or is it just pretty simple working with a contractor, getting the estimate, supplying that to you? Like, is that a pretty cumbersome process in terms of underwriting a loan like that?
So there's two components to it. One, as far as from an investor standpoint, we're going to underwrite that the same way we would other loans. I mean, so we're going to look at tax returns and things like that. From the appraisal standpoint, we're just going to underwrite it based off of those repairs being done. So we are going to need a bid, and we're going to have to break down labor and materials so we can figure that out. But the part that can be cumbersome is we have to vet out that contractor, because what we don't want to do is have one of your investors buy a house and they've got $50,000 for repairs and the contractor skates town after he gets that first advance. So what we'll typically do is we'll vet out contractors in the area ahead of time.
Okay.
So then that way we don't have to do it once the process starts. You just your investor would reach out to a contractor, they give them a bid, and boom, we just move right through the process.
Cool.
But if you have to vet the contractor out, that can add an additional 3 weeks on to the processing time.
Okay.
Good. I'd like to get into a little bit of the LLCs. I think we're kind of wrapping up to the tail end of this. We've got a lot of amazing information already out there, but one of the most common questions that I get all the time is, should I open an LLC? If I do open an LLC today, before acquiring an investment property, can I open that LLC today and come to you and then go ahead and take out a loan in that LLC? And let's say I purchase the property under my name today, and the lender options under my name, and then I want to transfer it into an LLC right after closing. Would you suggest that? Is that a possibility? Is that a no-no? I've heard that there's immediate payoff if you want to, and Mike, help me with the terms here, but if you want to transfer it to an LLC or you want to sell it, then you have...
I think it triggers the due on sale clause.
Due on sale clause. Thank you.
I think. I know a lot of people do it. It's kind of like technically you shouldn't. So I don't know. Maybe just thoughts on
what are the no-nos there?
Yeah. So, and it is a common question. So, an LLC, should they get one or not? From a lending standpoint, it's not so much a question for us to answer. It's more of a liability. If I've got an investment property and somebody falls or gets hurt, if they bring a lawsuit towards me, I don't want that to hit me personally. So I'd have a limited liability corporation set up as an umbrella. So it would hit that. There's your traditional products won't allow you to close a loan in an LLC name. I guess we'll back up one step. Can I borrow in an LLC or can I vest it in an LLC? So most residential lenders will tell you when we loan money, it has to be to an individual. So we're going to look at a social security number, not a tax ID. So you're borrowing the money as an individual. The question comes in next is, can I vest it in an LLC? Traditionally, what people would do is exactly what you were talking about, Chris. I would just close it in my name, mine and my wife's name, and then at the day after closing, I would quitclaim deed it from myself into an LLC. It's one of those things, I think the best way for me to describe it is if you're driving on the interstate and you're doing 58 and a 55, could you get pulled over for that? You could.
Right.
Do you get pulled over for that? No. So could a lender call that note due? They could. I've never seen it.
Yeah.
Because a lot of times what people will do is they'll do that with a trust. Like I'll close a loan and then afterwards I'll deed it into my trust, for estate purposes. But you don't have to worry about that with a DSCR, and then also with our Flex product, you can actually, the day you close, we will vest it in an LLC. And people get real confused because you're still signing all the documents at closing in your personal name. But the stuff that gets recorded and that's public record is in an LLC.
Right.
And so that's what people will see when they pull up the deed or anything like that. But you're still signing as a person, but it's vested as an LLC. So you don't have to quitclaim deed that after closing. You can do that day one.
Gotcha.
Is that on all three? So we have conventional, which you technically can't do that. And then on the other three products that we talked about, is that the way that happens, or is that just on the DSCR ones?
Well, on our Investment Flex product, you can do an LLC and the DSCR.
Okay.
So your traditional ones, you can't. And that might not be the case for all lenders, but that's more times than not, that is the case, that on your traditional loans, you have to vest it in an individual. But on our Flex and on our DSCR, the day you close, you can vest that in an LLC.
Okay, so let me just summarize it just to make sure I understand. So on the Flex and the DSCR, you can take title in an LLC, but then personally guarantee it with the bank for the loan product itself.
Yeah, because the flip side of that is if I truly do want to get a loan under my LLC, that's a commercial loan, not a residential loan. Right. And then what they're really going to look at is they're going to look at the assets and the longevity of that LLC.
Of the company.
Yeah, so that's what they're but we're a residential lender, so we don't do commercial loans.
Right.
But so that's why everything's in the personal's Social Security number, but the investing is where most people get confused.
Gotcha. So there's also a lot of concerns about today's economic conditions, probably no different than any other time, I'm sure. There's always something to panic about with the current market conditions. But with the current market conditions, what's your personal advice? Do you think now's a good time to get into investment with the current loan vehicles that you currently have available, or should they wait?
Well, I think the first thing is defining reality. I mean, we'll have some investors call us and they want to buy an investment property and they want to cash flow to where they could quit their day job. I want to cash flow $70,000 a year off this first property.
That's right. I get that all the time. Yeah.
And I would love to do that too. Yeah. So I think it's defining reality. And I think what you're seeing, I mean, we'll have investors come in and buy 10 properties within a quarter because they look at it as, I'm investing, I've got money in the market and I'm pulling it from the market to real estate. And so there's two components there. It's not just a cash flow, it's will that asset appreciate? And I'm looking at that. Is it stable? Can it complement my portfolio that I've already got going? So that's one way to look at it. So you might not cash flow as much day one, but I also think you're seeing rents, renewal rents, are being able to go up at a higher rate than new rents in some regards. It's different in each market, but I think it's if you've got a long-term investment on it, if you are outlook on it, if you also are looking at it to complement something, then it can be a great idea. And I think because there's so many buyers that are on the sidelines right now. And you know, you just got people that don't want to buy into, and I tell people, if you're not going to live in a house for 3 years, you shouldn't buy. You've got to have that time period. So we have so many people are wanting to rent right now. And so I think there's a huge opportunity for investors.
Okay. So kind of follows the rule. The best time to buy was 20 years ago.
The
second best time to buy is today. Yeah. I mean, I completely agree. So I'm glad that follows our advice. Otherwise, we'd have to cut that right out of the podcast. Because if you sat and said, no, you should wait, that's just not going to work. No, that's great. So I think we've covered a lot of the options that are available to new investors, to expanding portfolio investors. Is there any other additional piece of advice that you might give someone looking to buy or invest in real estate?
So what I try to do is we've got a tool that will actually, it's almost like if you were to go to your investment advisor and say, I'm thinking about an ETF, or I'm thinking about Bitcoin, or I'm thinking about whatever, your investment advisor is going to put together, okay, well, here's what you're looking at. If you invest X and maybe you do it over the next 5 years, you stop, this is what your return will be. We have the exact same thing for investors, for rental properties. We'll share with them, you know, we almost treat it like it's the same thing. What will be our ROI? If you buy this property and this is your cash out of pocket, we're looking at what can we cash flow? What's the appreciation? What's the amortization, paying down that principal? And we'll say this is your ROI in 3 years, 5 years, 7 years, 15. So that's a free tool that we provide someone. And you don't have to do an application or get your credit pulled, but it's just an idea. So you're not just Googling something, you've got some data behind that. And then you can decide what can I credit qualify for? Where am I in that process? And a lot of lenders, and we do this, we'll even do a soft pull on their credit. So once again, we're allowing you to dip your toe into this, feel if it's something that sets realistic expectations, and then see if you can actually qualify. And then you can go down that path of achieving that dream. So I would encourage everyone to explore real estate as an investment, and then just see if it's right for you. See if the numbers add up and if the expectations match what you're trying to do. I think that's great. Do you have any advice on where someone should start? Let's say they get the idea today that they want to invest in real estate. Where would you suggest that they start? Now, I always encourage people to start thinking about developing their team, but
and that includes mortgage lenders, real estate agents, property managers. But do you think that you should be their first stop to see if it's even a viable option for them, considering their personal financial situation?
Yeah, it's that analogy. I don't want to go test drive a Porsche if I can't buy it.
Yeah, exactly.
That's just and then I'm only going to think about that Porsche, right? That's right. Yeah. So, and I go back to my Ford. So, I think
nothing wrong with Fords, by the way.
No, that's what I drive. So, I do think you want to start with one. I think the numbers. I think one. Are you setting realistic expectations?
Yeah.
What can, and do you understand the investment on that? Because I will have people call me up and they don't have any money to put down, and that's just not what this is. So I would say start with the numbers, and then I think you do need to feel like or talk to a lender and see what can I qualify for.
Yeah.
And then they can get with a property management group, a realtor, and really start to put that team together and put the pieces in place.
Perfect.
Let me ask you on if we get investors calling us all the time and varying levels of I would say aggressiveness in terms of adding homes to their portfolio. If you had somebody and they say, hey, I want to be fairly aggressive, I want to pick up, I don't know, let's just say 20 homes in the next, 2-3 years. Is there any limit? I'm assuming you would probably steer them more towards the flex lending or the DSCR, but is there any limit to a number of loans that I can have? Is there anything limiting me other than down payment?
Yeah, well, so we did, this was just after, say, 2020, 2021. I had an investor come in and we were closing, we closed $1.5 million worth of business in less than 120 days. And so some companies, and we were one, we put a limit on our exposure to one individual that quickly. So it's like, that was $1.5 million. And on some of those properties, he hadn't even made a payment yet. It hadn't come due. So that was a traditional product. So we had limits. But as far as DSCR, there are no limits. So if they've got the cash flow, what we'll typically do is you don't have to space them out either. So we had a lady from California, we closed 2 on the same day. What's nice about that is she used the same underwriter, the same process, so everything was streamlined. She submitted documents one time. She just happened to buy 2 properties. So there are some products where there is no limit. So if you credit qualify and you've got the asset, you could go through and buy 50 in a month.
Interesting.
But if you're trying to do a traditional product, there could be, obviously there's the limit of 10 finance properties, but then there could be other lenders.
I don't ever know if I asked that question specifically, but the limit to conventional mortgages that you can have, kind of Fannie Freddie, is 10. You can only have 10. So
10 financed, yeah.
So if you had a slow and steady kind of investor who says, I want to add maybe 1 a year for the next 10 years, the cap is 10, including your personal.
Yes.
Okay.
I think that's going to do it. I think we're coming up on the close, coming up on the wrap. Any other final thoughts that you want to add, Tevis? We really appreciate you joining us here today, spending some of your valuable time. Also, please tell our listeners where they can find you. How can they connect with you? Let's get into that a little bit.
Sure. I would say that this is an ever-evolving market, an ever-evolving product set. So the guidelines could change daily. They could change weekly. So, I tried to be general with that, but that's something just to stay on top of if you've got a lender that you trust. They can find us. Our website is supremeindiana.com. It's got information about me and my team. And then from there, they can get our address to our office, our phone number, and our email address and all that.
Okay, perfect.
Awesome.
That's a wrap on today's episode. Now, next month, we are going to be joined by Margaret D'Souza, who's part of our real estate staff on the sales side. So be sure to check that out, and we're going to be able to get you connected with a full team so that you can start getting into your real estate investments and how you can expand your personal portfolio. Tevis, thank you again very much. It was a pleasure to be with you. Mike, it's always a pleasure to be with you. We never spend too much time together. But yeah, that's a wrap. Be sure to check out next month's episode, also our rental market reports that we put up every single month. Be sure to like and subscribe. We'll check you in the next episode. Thanks.